And today we're examining indexed universal life and how it would compare to perhaps a hybrid annuity or annuities in general.
Right.
So,
hey, first of all, let's say thank you, Eric, to
Steve up in Wisconsin for
right.
submitting this question. And please continue to submit your questions, and we'll examine them as the weeks go on. So for those of you that submitted questions,
We've got some
in the hopper. And for those of you who have questions, keep them coming.
So today, in comparing the Indexed Universal Life, and it's also called Equity Indexed Universal Life, or EIUL, but the more technical, correct term would probably be IUL. Yeah. Very safety-oriented product. It's a life insurance product. And there's a lot of good comparisons we can do with that and annuities. So why don't we just start off talking about the life insurance part first, right. The IUL.
And we don't talk about life insurance too much here.
As much.
So let's talk about why someone would even
why would you want to compare it?
In this sense of, I'm going to think of it in terms of, if I'm not going to select an annuity for retirement income, would I select an equity, or in this case, an indexed universal life policy?
Or if I was looking at growth compared to, I'm just saying, if I was comparing the two for growth, maybe, right. Okay, maybe I'm getting it. Go ahead.
You're jumping ahead of you.
I'm jumping ahead of you.
Darn it! So what we want is trying to grow the policy to the largest amount, yes. So that we could use it for a retirement supplement. Because really here we're talking about the living benefits of the IUL, in this case, being able to use it as a supplement for retirement. Now, what it has is the ability to have a double-digit cap compared to with the low single-digit caps of today on the annuity world or in the hybrid annuity world.
And that's large, Eric, because when we look at the caps on most annuities, the fixed indexed annuities, which are referred to as the hybrid annuity, the caps are down below 5%, some substantially, right. Down in the 2.5%, 3% right. range. So when we start talking about the IUL, now we're looking at 10%, 12%, 15% caps even.
Right, so we have growth potential. Because right. Here we're talking about index schemes. There's right. Not that right. Guaranteed roll-up side.
Right.
Now, so on the hybrid annuity side, you've got those income riders that have some of those guarantees.
Contractual guarantees for future income.
So that's the one comparison on kind of the cap side.
Right.
Now,
right.
Now, what are we going to use for withdrawals on the life insurance side? How are we going to get money out of this?
If we take actual withdrawals, we're going to pay taxes. So we don't want to take withdrawals.
Well, then why would we even consider this?
Well, and when we compare that to an annuity, when you take withdrawals out of an annuity, right. You pay taxes. But there's a really nice aspect to the IUL, and that is that you can borrow out of it. And it's just like the old traditional whole life policies. You can borrow out of it and not pay tax on it. And the IRS has allowed that on borrowed money. Anytime you borrow money from a bank or anywhere, there's no tax paid on borrowed money.
Now, do I have to pay this money back?
Actually, technically you do.
You do. But when do you have to pay it back?
Through your death benefit.
And that's the key element here.
Right.
It's really part of the death benefit, and that's what makes it, basically, you're going to pay it off at some point in time.
Right.
Those dollars that you've accrued are going to get paid back at the time when you're gone, basically, as that death benefit is dispersed.
Right. One of the things that I want to bring out is that if you want to use the IUL, folks, you cannot use your qualified funds or your IRA money unless you're willing to just go ahead and pay the tax on it and move it over. And then you have to do a real analysis on how that might.
Just as a reminder, neither of us are accountants or tax professionals, so we would advise you to consult your tax professional when it comes.
Although we work with this every day and constantly talk about the taxes.
So now, government going to come in and take my tax benefit away?
Well, that is a question we are frequently asked. I'm asked that on the Roth. I'm asked that on life insurance, or life insurance that's being used in more of a retirement account type situation. And the answer to that is it can happen. It could happen. However, if we go back and look at other times where Congress has stepped in or government
screwed us,
took advantage of us, typically they have grandfathered us. So that if we are in a situation where, in good faith,
grandfather's covered and I get screwed.
So if we operated in good faith and set this up and did it under the current tax provisions and laws. And by the way, this is the IRC, Internal Revenue Code 7702 provision, same type of thing that
he wants to be an accountant.
That the IRC 401k, same area that comes from. It's the 7702. So if you see the 7702 plan, that's what they're talking about. It's very legitimate, it's very real, and it works. And a lot of professional people use this because they can put large amounts of money in, they keep their principal safe, they lock in their gains, they've got annual reset. There are some wonderful things about it. But Eric, who's it going to work best for at what stage?
You got to be in your accumulation stage. It's probably the easiest way. So young professionals, perhaps, I've heard it called a big boy Roth because you can dump oodles and oodles of money into it and let it grow.
Correct.
There's not a limitation to the contribution amount. Now, they have to be dialed in the right way, and that's one of the things.
Little secret.
Yeah, strategy-wise, usually you have the smallest amount of death benefit that you can have on life insurance.
Which means you pay the least amount for insurance.
Exactly.
And the agent makes the least amount on
commission. So you can see how there might be a confliction amongst the person that might be trying to talk to you about this. So usually we see only larger client.
I like that word though, Eric. Confliction.
I got an ointment that I can take care of
that.
So yes, when your conflicted agent comes in and says, "Hey,
we need to make sure you got plenty of life insurance." Now, and let's not go too far on this because there are times when a lot of life insurance is good for heirs and different things. So, but for the way to make an IUL really work well, and again back to that original question I had posed. And that was what stage, and I'm just going to go ahead and answer it, say
15, 20 years.
Yeah, 40 to 50 years old that you can really let it sit.
You're 15 to 20 years from retirement. You have to have at least that amount of time really for it to function well.
Right.
And that's the key, I think, because that point in time it starts to get the extra dividends, the extra pieces, the extra credits that can make it really hum. And then you can have a rider on there that has a guaranteed income loan provision for life. So you can treat it very much like an annuity. But you have to have the forethought to have done this 15, 20 years before retirement. So,
correct.
So if they haven't done that, income guarantee-wise...
It's really based more on potential.
Yes.
Yes. Now, let's talk briefly, because this is a long video.
Yeah.
Let's talk briefly about the annuity and why the annuity would have certain aspects and advantages over the IUL, because the IUL is pretty cool the way
it's very
works.
cool. I love them. Now, I would say guarantees, though.
Guarantees,
especially guaranteed lifetime income for someone that's nearing or close to retirement, is the key.
Right.
That's I don't want to say it's the singular piece, but it is the first and foremost.
Because with the IUL, I have to have potential. And with I have to have I have the potential for growth, and I have to get the growth through that potential.
Right.
But with the annuity, I have a contractual guarantee.
Yes, and that's the key. We've talked about the hybrid aspect. You also have other annuities, such as immediate annuities, where you're going to have payouts of your principal plus.
Yes.
Guaranteed for life. Now the insurance aspect, without a rider, you could actually run out of basically enough account value, because you have to keep the insurance in place long enough to die, because if you don't die with insurance left, you haven't paid off your loans.
And probably, Eric, the best advice that we can give you beyond the general information we've just given you is work with an advisor that really understands how to compare these two. And maybe it's not one or the other, maybe it's some of both.
Yeah, it could be. Yeah, it depends on your end goal. What do you want these dollars to do for you? So work backwards and work with an expert.
Steve, thank you for this question, and those of you out there that have questions, we probably caused you in this video to have some more questions. Feel free to send those in to us, and we look forward to answering them.
That's right. As you can see, we'll tackle just about any question as long as it relates somewhat to our annuity world.